Robschild. Nothing I say is investment advice. Welcome to the show where we view financial markets through crystal ball gazing. J.P. Morgan once said, "Millionaires don't need astrologers, but billionaires do." And so we begin. Today is Tuesday, April 9th, 2024. This week we have Wednesday CPI coming out, Thursday PPI coming out, and what I hear are some important bank earnings coming out on Friday. And so, all of the chaos that might come out of the CPI and PPI and earnings on Friday might not really settle into markets until the following week, until Monday. It will be very interesting to see what happens here, because if the CPI turns out to be way higher than expected, then, we'll be looking at less cuts, maybe even a hike coming up. Who knows? They keep talking about cuts, so, it seems most people, most market participants, most people that are involved with watching markets are actually expecting a lower than expected CPI print to be coming out, partly because of sort of the language that's been coming out of the Fed, talking about how, yes, they're acting like they are looking into a crystal ball and saying, yes, we're going to be cutting, and so it will be interesting. It's an exciting time in markets starting tomorrow. For now, not a whole lot of very interesting things to look at. We have the S&P 500 still moving sideways within the range of this previous candle last Thursday, this big scary red candle. We're still inside of it. We still haven't broken out of it up or down. If we do break out of it up or down, it really could spell where we are going from here. As I've been saying for a while, my crystal ball says that we've hit the top, and that I am expecting this to be selling off here. My reasoning is really fourfold. First being the overvaluation in a lot of the mega caps, especially in the chips and the semiconductors. Secondly, we've had Fed hiking cycle that has been extremely aggressive, and once the earnings start contracting, I believe they're going to start contracting pretty quickly. We haven't seen earnings contraction yet, and so there are arguments against what I'm saying, but I don't think I'm alone in seeing, just looking into the future as to what's next. If we're looking at cuts, again, typically once we start cutting, it's because it's too late, and then we need to cut more and more and more as people are losing their jobs and no one can afford anything, and everything goes bankrupt, and chaos ensues. Third reason, it's the unemployment number for me. We got as high as 3.9%. This is part of the SOM rule, by the way. We've surpassed it, if you want to look into that. And we went to 3.9%. We ticked in the last report down to 3.8%, and it's one of these charts that looks like higher highs and higher lows, and I see it continuing until the pattern breaks. Otherwise, I do see this as a problem. Is it a huge problem right now? No, not exactly. But looking just a little into the future, I don't know. It looks a little bit clear to me. Maybe I'm wrong, but I'm wrong. I'm the guy with the crystal ball. And I don't remember what the fourth reason was. Probably doesn't matter. Those three pretty much sum up my viewpoint. The only real notable chart I found very interesting today was copper miners. I suggested yesterday this hangman candle looked like it could turn into a reversal here. It's a good thing I'm not a day trader, because I probably would have gone short here, seeing this, major run up and then this hangman candle here. And we just popped right up higher. Copper, people are excited about copper miners, apparently. So it'll be interesting to see where that goes from here. Again, across markets, nothing all that interesting going on. There's, it's all about the CPI. That's when things get exciting, plus the PPI and bank earnings on Friday. Now, I wanted to move on to discussing, what how should we be thinking in this environment, or what do I think about this current environment? And the question that I always want to ask myself is, okay, I think stocks are expensive, I think gold is expensive, I think silver is not cheap, I think housing is not cheap, I think oil is not cheap. So where are the opportunities? We have inflation. Our dollar's a good idea when you have high inflation, when you're losing buying power. I've discussed on this channel before how I'm 40% in long duration treasury bonds, and I'm comfortable with this because it still looks like one of the cheaper opportunities out there, and I'm very comfortable to have 40% in there. 50%, I'll wait a little bit to go in even heavier here, especially if rates go up. It'd be great to lock in more, raising it to a 50% allocation if we get up to the 5% marker. I think that would be nice. Can rates go up and the bonds that I have lose value? Yeah, it's possible. Well, what are the probabilities on here? I just wanted to go over a few things with that. Before I continue talking about rates, I forgot to bring up this headline as part of the main show. Costco selling as much as $200 million in gold bars monthly. So I wanted to talk about this headline really quick. And, I didn't think gold would get much higher than $2,000 an ounce, and it has. And it broke out. People think it's going to keep going up. And I mean, come on. Okay, so what always happens when everybody starts piling into something? I mean, I'm hearing professional investors talk about how gold is actually underinvested in compared to history. Like, hedge fund managers don't have a very large allocation of gold to what they normally would have. Like, I can kind of understand that reasoning, but gold is by no means cheap by historical standards. If you compare it just to the price of oil, the price of food, how many loaves of bread can you get for an ounce of gold? Gold's extremely expensive right now, the way that I see it. And now that I see headlines like this with Costco selling $200 million of gold bars every month, these are not institutions. These are retail investors, and unfortunately, the retailer tends to get hurt the most and the most frequently. And so this, for me, seeing everybody piling into physical gold, buying that much gold from Costco, it spells out disaster for me for the price of gold. I'm not interested in gold at all right now. It's not clearly cheap. Again, so what is clearly cheap? Back to the discussion of bonds, rates. I shared this chart before, found this on a number of websites. I'm not sure where the exact origin actually is of it, but I just wanted to bring up, okay, so, how do you know when bonds are cheap? When debt has a surprisingly high yield. And when we look at this chart, this obviously doesn't go into today, because we're currently above the 4% marker in across the entire yield curve. But if you look back to 1350, and what I like to do, I draw a line at 4%. We're currently over 4% in all across the curve from 1 month to the 30-year bond. What I like to do with this chart is cover up above, and as you can see, especially, it gets a little spotty and hard to interpret before the 1700s. But if you just take a look at this, I cover up the top. Most of the time, besides the 1970s, we are at lower rates. And how much are we above? If I cover the bottom of this chart, it's a lot. Overall, I would say it seems a lot less frequent. And so when we are above this 4% line, this looks to me like it's likely a good time to be investing in bonds when the rates are high. And if you get long duration bonds, you can sell them with a lot of capital appreciation when rates go back to more normal levels, which I would suggest is closer to 3%. Adding to that, with aging demographics, if it plays out the way it played out in Japan and the way it's expected in an aging population, we could go as far as 0 or negative. I do believe negative interest rates are in the future of the United States, but we will see. From a slightly shorter time horizon, if we look at the last 20 years, again, we're right here at 4.36% on the 10-year note, and we haven't seen it this high since 2007. And so, from a shorter term perspective, it does also look like a discount. As I've said before, when people have gotten used to borrowing at much lower rates, and the expense of interest being high and staying high, some people say this is inflationary, and I get it, because the people owning bonds are getting those payments. That's sort of inflationary, especially like directly from treasuries. But that affects the borrowing costs of everybody, for mortgages, for businesses, and as well. And that doesn't equate inflation. Higher rates for business lending does not equate inflation. In fact, what it does is it puts a strain on businesses. It puts a strain on how much money they're able to earn, especially. And that's why I keep talking about there being a future earnings contraction, where these rates hurt. They get expensive long enough to the point where it's like, okay, we're going to start having to cut, and then that's the business cycle, and bad credit gets flushed out. Lots of companies go bankrupt. It's just a part of the business cycle. This is not like the end of the world kind of a thing. So that's what I see. Anyway, so what other areas? I just wanted to bring up two other charts that are more obviously cheap, all right, of like potential investment opportunities. And I've talked about these before, and I'm going to talk about them again. This is a Chinese internet ETF. Basically, it holds like Google type companies, Facebook type companies, Amazon type companies of China. So they have their own websites over there, JD, Alibaba, etc. And if we look at this chart here, and the value of these stocks are the same as they were apparently in 2013, yes, this is more obviously, to me, this is blatantly obviously extremely cheap. And yes, I understand the political risk, currency risk, a lot of political risk there is, but Benjamin Graham, Warren Buffett, uh, very smart people see that the world is run by business, and at the end of the day, yeah, I mean, business runs the world, and these businesses are cheap right now, and that's pretty much all you need to know about it, in my opinion. So one other thing that I think is cheap, I've mentioned this before too, REMX. This is a rare earth strategic metals ETF. They do a lot of platinum, palladium, catalyst converter metals, as well as lithium. And I've mentioned before, in 2011, the value of the companies producing these things was up over $300, and even with inflation, you know, this whole fund is only worth $55 right now. I mean, at some point in the future, it is very clear to me that we will eventually get up to that mid $300 range again at some point. Can this get cheaper? Yes, it definitely can get cheaper. But it's one of the things that is more obviously cheaper than other things that are out there. And so those are the opportunities I wanted to share on this video. Again, nothing I say is investment advice. I hope you enjoyed the show, and thank you for watching. Robschild.